The average American household carries $31,000 in debt, not counting their mortgage. Add the mortgage, and you're looking at over $200,000 per family. But here's the part that should terrify you. The entire global economy now runs on $421 trillion in total debt. That's more than 4 times the GDP of the entire planet. If everyone owes money, who exactly is owed? This isn't conspiracy, this is documented history. The meetings happened, the contracts exist, the mechanisms are public record. They didn't hide it because they didn't need to hide it. Let me show you exactly how they built a debt system so perfect that escape became mathematically impossible. Before we go through the pattern, you need to understand what sovereign debt actually was before they transformed it into a control mechanism. For most of human history, kings borrowed money during wars and paid it back when the war ended. The debt had a purpose, a timeline, and an exit. What we have today isn't debt in any historical sense. It's a perpetual extraction system designed to ensure that the borrower never escapes and the interest never stops flowing. They built it in stages across 3 centuries, and once you see how they did it, you'll understand why financial freedom isn't just difficult today, it's systematically prevented. Let's start with the Bank of England in 1694. King William III needed money to fight France, but he didn't want to raise taxes on his wealthy supporters. A group of London merchants led by William Paterson offered him a deal. They would lend the government £1.2 million at 8% annual interest. In exchange, they would receive a royal charter to operate the Bank of England and issue England's currency. Here's the key detail most people miss. The loan was structured so it could never be repaid in full. The bank would create the principal amount of £1.2 million, but not the interest. This meant the government would always owe more than existed in circulation. The bank's own founding documents stated that the debt would be perpetual and that the annual interest payments would secure the bank's profits in perpetuity. Within 20 years, the British national debt had grown from 0 to £50 million. The interest payments alone consumed 30% of all tax revenue. This wasn't incompetence, this was the designed outcome. Now let's look at how they exported this system to America. In 1813, the United States had been debt-free for exactly 1 year after paying off the debts from the Revolutionary War. The War of 1812 changed everything. President Madison needed to borrow money to fight the British, but American banks couldn't handle loans of that magnitude. A consortium of European banking houses, led by the Barings Bank and the Rothschild family, offered to finance the war through government bonds. Here's where it gets interesting. The loan agreements included a provision that the bonds could be rolled over indefinitely, with interest payments due every 6 months. Nathan Rothschild wrote to his brother James in 1814, saying, "The few who can understand the system will be so interested in its profits, or so dependent on its favors, that there will be no opposition from that class. The great body of people will never understand it, and therefore will bear its burdens without complaint." By 1816, the U.S. national debt had grown from 0 to $127 million. The interest payments required the creation of the Second Bank of the United States, which would issue currency to service the debt. The pattern was now established on both sides of the Atlantic. The third stage happened in Germany during the 1920s. The Treaty of Versailles had imposed reparations payments that totaled 132 billion gold marks, roughly $33 billion at the time. This was more than Germany's entire GDP. The German government couldn't possibly pay this amount through taxation, so they had to borrow from international banks to make the payments. J.P. Morgan and Company arranged the loans through a series of bond issues sold to American investors. Here's the crucial detail. The loans were denominated in dollars and gold, but Germany's economy produced marks. This created a currency mismatch that made default almost inevitable. The Dawes Plan of 1924 restructured the loans with even more favorable terms for the creditors. Young Plan of 1929 extended the payment schedule to 1988. The loans came with strict conditions. Germany had to pledge its railways, its customs revenues, and its industrial assets as collateral. When hyperinflation destroyed the German economy in 1923, the international banks seized control of German infrastructure through their loan covenants. It was economic colonization through debt, and the mechanism worked exactly as designed. Let me show you the four-stage sequence that runs through every case. Stage 1. Create a crisis that requires emergency borrowing. War, economic collapse, natural disaster, it doesn't matter. The emergency provides justification for debt levels that would never be accepted in normal circumstances. Stage 2. Structure the loan so full repayment is mathematically impossible. Lend the principal, but not the interest. Create currency mismatches, or set payment schedules that exceed the borrower's capacity to generate income. The key is ensuring that the debt grows faster than the ability to service it. Stage 3. When the borrower struggles to make payments, offer to restructure the debt with more favorable terms for the creditor. This isn't mercy. This is the trap being sprung. The restructuring always comes with conditions that transfer real assets or policy control to the lender. Stage 4. Use the ongoing debt service requirements to maintain permanent influence over the borrower's decision-making. The debtor becomes a client state, whether it's a nation or an individual. Now let's check where America stands today, using this exact framework. Stage 1. The crisis phase has been running continuously since 1971, when Nixon closed the gold window. Every recession, every war, every emergency has required more borrowing. The national debt has grown from $400 billion in 1971 to over $32 trillion today. That's an 80-fold increase in 52 years. Check. Stage 2. The mathematical impossibility of repayment is now obvious. The federal government collects roughly $4 trillion in annual revenue, but owes $32 trillion in principal. At current interest rates of 5%, the annual interest payments alone will consume the entire federal budget within 10 years. The Treasury issues new debt every week just to pay interest on existing debt. Check. Stage 3. The restructuring is happening through Federal Reserve policy. Every time the debt burden becomes unsustainable, the Fed lowers interest rates or prints money to buy government bonds directly. This isn't economic management. This is debt restructuring, with the American people serving as collateral through inflation and currency devaluation. Check. Stage 4. Policy control has been transferred to the creditor class. The Federal Reserve, which is a private consortium of banks, now determines interest rates, money supply, and effectively controls fiscal policy through its bond purchasing programs. Congressional spending decisions are constrained by debt service requirements. The government serves the creditors first and the citizens second. Check. The pattern runs deeper than just government debt. They applied the exact same system to individual Americans starting in the 1970s. The Federal Reserve lowered interest rates to encourage borrowing, while banking regulations were systematically dismantled. Credit card debt, which barely existed in 1970, reached $1.7 trillion by 2023. Student loans, which were negligible in 1970, now total $1.8 trillion. Mortgage debt reached $11.9 trillion. Auto loans hit $1.6 trillion. The total household debt load is now $21 trillion, and it's growing faster than household income. Here's the crucial part. Just like the government bonds, consumer debt is structured so it can never be fully repaid by the majority of borrowers. Credit cards require only minimum payments that barely cover interest. Student loans have been extended to 30-year terms with income-based repayment plans that ensure most borrowers will never pay off the principal. Mortgages are structured as 30-year amortizing loans, where the first 15 years of payments go almost entirely to interest. The system produces perpetual debt service, not debt elimination. The architecture becomes clearer when you look at who holds the debt. Government bonds are owned by a combination of the Federal Reserve, foreign central banks, and institutional investors like BlackRock and Vanguard. Consumer debt is packaged into securities and sold to the same institutional investors. The debt holders are a relatively small group of financial institutions that have positioned themselves as the permanent creditor class. They don't want the debt to be repaid because debt repayment would eliminate their income stream. They want debt service to continue forever, and they've structured the system to ensure exactly that outcome. What happens when a debt system reaches mathematical impossibility? History gives us clear examples. The Roman Empire debased its currency to service debts and collapsed within 2 centuries. Weimar Germany experienced hyperinflation and political revolution. The Soviet Union defaulted on its external debt and ceased to exist. But the current system is different because it's global. There's no external economy to absorb the losses when the debt system fails. The mechanism they built is so comprehensive that failure would take down the entire global economy. Here's where we are in the sequence. The debt-to-GDP ratio has already passed the point where historical empires collapsed. Government interest payments are consuming an increasing share of tax revenue. Consumer debt service is consuming an increasing share of household income. The Federal Reserve is trapped between inflation and deflation, unable to raise interest rates without triggering mass defaults, unable to lower them without destroying the currency. The system is approaching what economists call a debt spiral, where new borrowing is required just to service existing debt. If the pattern continues, stage 5 becomes inevitable. Mass defaults begin when interest payments exceed the borrower's ability to make minimum payments. This triggers stage 6, which is asset seizure on a national scale. The creditor class uses their debt claims to acquire real assets at liquidation prices. Land, infrastructure, natural resources, and productive capacity get transferred to the debt holders while the borrowers lose everything they pledged as collateral. It's the largest wealth transfer in human history, and it's designed to look like a natural economic process rather than a planned extraction. The timeline for this process depends on interest rates and economic growth, but the mathematical constraints are getting tighter every year. If interest rates stay above 4%, the federal government will be spending more on debt service than on defense within 5 years. If economic growth stays below 3% annually, consumer debt will become unsustainable for the majority of American households within a decade. The system they built has its own internal clock and time is running out. What can you do with this knowledge? First, understand that traditional financial advice assumes a system designed for your success. This system is designed for your debt service. Paying off debt aggressively makes sense, but only if you can actually achieve debt elimination before the system collapses. If you can't, the minimum debt service while accumulating hard assets may be the better strategy. Second, recognize that currency and bonds represent claims on a system that's mathematically unstable. Physical assets, productive capacity, and scarce resources maintain value when debt systems fail. Third, develop income sources that don't depend on the debt system's continued operation. Skills, relationships, and local production capacity become crucial when centralized financial systems break down. The debt system they built over 3 centuries is approaching its mathematical limits. The signs are everywhere once you know the pattern. Government debt service consuming larger shares of tax revenue, consumer debt service consuming larger shares of household income, central banks trapped between inflation and deflation, and asset prices disconnected from productive value. They built a system so perfect at extracting wealth that it's now consuming the economy it was designed to parasitize. Subscribe to this channel because they're not going to teach you this in school. And when stage 5 begins, you'll want to understand exactly why your financial world is collapsing and who benefits from the destruction.